So again, good afternoon, everybody. This would be the third installment of our Brain Trust Masterclass being hosted by Research. You know, I had a very long Easter break. I think the last time was in March. And then again, we had a little COVID break again. So now we're here to actually resume our lessons. So I just want to give a recap in terms of what exactly we were trying to achieve with this masterclass series. So for the purpose of this series, what we're really trying to do is enable our staff not only research and sales, but essentially anybody that wears the Barita brand to be able to speak with a sense of confidence on any financial topic. So for example, if you go to the supermarket and you so happen to be in a Barita shirt and a potential client or a client approaches you, you should not be feeling flustered or nervous or jittered because it is not your area of expertise. The reason for these classes is that we're allowing you to develop that sense of confidence in speaking to clients. So we're essentially going to give you an idea of what goes into doing research on a company. Pretty much of the light stuff, but you still be able to get an understanding of what it entails. So the masterclass series really to equip our team with the requisite knowledge and information to perform their fiduciary duty. On the topic of fiduciary duty, what we mean by fiduciary duty is that if you have a client that is high risk, in terms of their risk profile is high risk, you would not necessarily want to mismatch that person with a product that is low risk because what? They have the capacity to take on more risk and see more returns. And the reverse is also true. You do not want to have a low risk profile client that you're mismatching them with a high risk product. In that case, you will have this mismatch and you will not have appropriately allocated that person in the right product. So that is where our fiduciary duty comes in. So we need to be able to understand at that level. Then next, we want to be able to have best-in-class insights and analysis to our clients, meaning that when you speak to a staff member at Barita, you should not be able to say they sound just like anybody else at any other brokerage house in the industry. Barita's staff and our products need to be a differentiated product and should be best-in-class on every front. Then lastly, is really to improve our staff confidence. I'd love if everybody would be able to be involved in conversations regarding financial market activities versus it being a situation where you're just simply asking from research or individual persons what is happening. It's better to have a dialogue. At that point in time, you're able to induce your own opinions and then share those opinions, and you're able to increase your knowledge pool. That is how persons generally learn, and that's essentially what we're trying to create here. Create that environment of learning. So on that note, this is the purpose of the masterclass. So we're going to kind of delve in a little bit. Again, this is the third installment, so we would have already gone through 2 installments. So I know most of the persons wouldn't have been here for the first 2. So we're going to do a brief recap into what we did in the first 2 classes. The first class was about where do we get our data. Now, against popular belief, research doesn't have all the information in our back pockets. It is not at Raman's office. It is not on the Richard's desk. Haughton doesn't go home with information at the end of the day. We do not store this information in-house. We actually have a website that we can go to get all the information that we utilize to do our research. Then our second class was about what type of data do we need. So once we have identified the source, what information do we actually need from this source? That information includes the income statement, the balance sheet statement, the cash flow statement, and the notes. So I'm going to go a little bit into where do we get our data. Now, if you work in the Jamaica financial industry, this is single-handedly the most, and I'll say it again, the most important website that you will ever need to know while working in this industry. You can close your eyes and you can type in this website. You should be able to notice at the back of your hand. Anybody asks you, where did you get this? You should be able to recite this like a hymn. This is the most important website. The reason why this is the most important website is that any information you need on any company that is listed on our stock market can be found on this website. Again, it's not in research department, it's not in any other department or any other brokerage house. It is literally housed on this website. So at no point in time should somebody be asking, where do I find the stock price for this company on this particular day? We don't have it in any books. We don't have it in any secret stash. It is right here on this website. To give you an idea of what this website looks like for those who don't use it, is that one of the easily one of the most user-friendly website actually that is in the Jamaican space. You can see just from the very first homepage that you can get a runner of all the companies that are listed on the stock market, and based on what type of activity is happening there, you're also able to see a different bunch of tabs at the bottom that allow you to say news, events, market data. When you scroll down a little further, the website is actually laid out in a very easily understood framework where at the top right here, you see where it says summary of market activities. You're essentially able to see a trend in terms of what is happening for that particular index. Our local stock market has multiple indexes, from the main market to junior market to our combined index, manufacturing index, financial index. This tab at the top right here allows you to actually see what is happening. And if you click view summary, you're actually able to see what was the changes in prices for individual stocks that traded on that particular day. Then further down, you see where you have Caribbean Assurance Brokers. This was early in February, March. You can see the latest developments regarding anything major that affects our stock market. That includes IPOs, any acquisition, or even developments regarding the stock market. For example, when we did partnerships with the Canadian Stock Exchange, that would have been announced right here. Anything you need to find that is important for the stock market will be displayed right here. So you say you want to go for a particular company now, on the right hand side of the screen, you're able to see a drop down list, and all you need to do is type in the company that you want to actually go to, and you're able to get a variety of information. So if you're talking about dividend schedule, if you're talking about corporate actions, if you're talking about even the latest news surrounding that company, you will be able to get that information by selecting it on the drop down menu on the right hand side of the screen, and you can find anything you need to know about this particular company. And this right here is under market data, which is essentially stores all the information you would practically need to know about the index. You can go as far back to see what was the index level at a particular point in time. You can find out what companies were listed during a point in time. You can actually find the website of all the companies that are listed on our stock exchange at the same time. Everything you need to know about any company that is listed on our stock market can be found on this website. And again, the website is JamStockX. Very simple. So when the first class is released and you'll be able to rewatch those videos, we would have gone through a live demonstration utilizing the website. At that point in time, you'll see how easy it is to use it. Due to time, we won't be able to do that this session, but again, I implore you guys, the website doesn't go down after 4:30. It is up right throughout the night, right throughout the day. You don't have to wait until we say look at the website. You can use it on your own time and play around with it. I mean, every information you need is literally right there. In our second session, we spoke about why do we do research and analysis? What's the point of it? So we know where to get the data, but why exactly do we need this data? What is the purpose of it? So the reason why we do research is necessary to allow an individual to get a clearer idea of how an economy works at the macro level, and then how businesses work at the macro level and how they operate. That is important. You cannot buy a company and you have no idea about it. You can't invest in an economy and you have no idea about it. You have to do research. You have to read about it. You have to be familiar with it. Remember, your clients and yourself, you're putting money into these companies and into these sovereigns. You need to know what is happening. The scope of your research is really to understand what drives the economy, what drives a company, what are the risks, what kind of interdependencies are there, what is the outlook for that company, what kind of performance have they done historically and to date. These are important elements you need to know. Every 5 years, they say an economy changes structurally, meaning that, what happened 5 years ago may not necessarily happen now. We had the financial crisis in 2008, 2009. Today, we have a different crisis, and it's not the same because it's always a structural change that happens right throughout any economy and through companies. So we need to be able to understand this set of information whenever we do any form of research. And then we utilize the information under uses to make objective and informed decisions. So once we have our checklist and we tick off and say, cool, we like this, we like that, they have this as a problem, but that's not too big of a problem. We check off and we say, all right, we are comfortable with this investment and we would execute on this investment. That is the essential purpose, reason, scope, and use of research and analysis. Now, once we know where to get our data, which is JamStockX, we would then look for these three important financial statements: the income statement, the balance sheet statement, and the cash flow statement. The second class, we went into details about the different types of income statements. For the purpose of this class, we won't necessarily go into that much detail, but I'll give a brief overview. Essentially, the income statement shows you how did the company operate. It shows the performance of the company. What did they do during this particular time period, whether it been 3 months, 6 months, 9 months, or a full financial year for that company. It shows you the performance of that company, which is revenues and expenses during that period. Then the balance sheet shows you what is the financial position, essentially what are the assets and liabilities, how did they generate those revenues, what assets did they use to generate those revenues, and also how did they acquire that assets, meaning did they use equity, did they use debt. The balance sheet shows you the financial positioning of a company at a particular point in time. And then finally, the cash flow statement links everything together. You would notice that I have everything in a circle because, as you can see, everything is connected. What happens on one statement happens on the other statement. And to showcase this, I will do a short example showing you how all three statements are actually linked together. So what you guys are looking at right now is what you should be seeing is a cash flow statement. I know the handwriting looks very amazing. Everybody's impressed, and I know it is one of the best handwritings you have ever seen in a long time, and that is true. Thank you very much. So what we're looking at is my makeshift cash flow statement. I decided to start here because this is essentially where you'd start any form of business, whether raising equity or raising debt. So let's say, for example, Barita decided to invest in me. I go to Raman. Raman says, hey, I go to Raman and say, hey, I have a nice business plan. Raman decided that he's going to invest in my company. He's going to give me $100 for 100 shares, each priced at 1. So I'm going to write down under my issue of shares, $100. And that will represent my CFF, which is cash flow for financial activities. That is where you record how did you actually raise your cash, whether it be in equity or through debt. So I'm going to write off my CFF as 100. Now, I'm not going to waste no time. I'm going to spend this money instantly. What am I going to do? I'm going to invest in an asset simultaneously. I record that actual purchase on the investing activities. On the investing activities, I'm going to spend this $100 outright. I'm not going to leave any money behind. I'm going to spend this $100 on the investing activities. So there, purchase of equipment, I have $100. Because it's a cash outflow, I'm going to put the brackets to represent negative, right? So again, I raise $100 in equity, and I simultaneously spend $100 on equity on an asset. So then I'm going to go to my balance sheet now to record this acquisition. Under my balance sheet, I'm going to say I bought furniture and fixtures for $100, because that is literally what I spent to acquire this asset. So I'm going to write down my $100. Now, some gentlemen and gentlewomen decided that, hey, we're going to have some accounting standards to represent that fact that, once you buy an asset, they're going to lose value over time. How does it lose value? It depreciates. Through depreciation, you have different ways you can record depreciation. Just for the purpose of this exercise, I'm going to use the simplest method, which is straight line. Essentially, I'm going to divide my asset by 5 because I believe it has 5 years of usage life. So I divide it by 5, I'm going to have 20 as my depreciation. So, So I'm going to subtract 20 from my asset, even with a total fixed asset of 80. Cool. Just doing a check. Everybody is following me so far? Just doing a quick check. Everybody's seeing and following? All right, cool. So from this point in time now, we already recorded our assets. We saw how we got our cash. Let's go to making some money now. So what we're going to do is move over to our actual income statement and start making some money. I'm able to use this asset and generate revenues of $1,000. So I'm going to recognize sales revenue of 1,000. I'm going to ask the question, what would be my cost of sales? What did I spend to acquire this asset to generate this revenue? Anyone can answer? No takers? $100. There we go. All right. So we record our $100. Hence our gross profit is now 900. Everything else is going to be zero for now. You know, no selling. We're using Barita facilities, so we pay a little rent. You know, we can't just want you to people in facility and not paying our rent. So we're gonna give them a little $100. You know, a drop in the bucket, but we have to make sure we pay our dues. Hence our operating profit is 800. Everything else from there is going to be zero. So let's put our zeros. Again, profit from operations is 800. You know, 0. Profit before tax is 800. The government can't want come tax rate, so we're not gonna pay no tax. A little bit of money, then we're wiki for do that. So we have $800 as our net profit. So we have finished with our income statement. Our auditor would have come on and signed it and said, all right, this reflects a fair representation of the business activities of the company. I know the handwriting looks good. I know everybody's impressed. So moving back to our cash flow statement now, we're going to record. So moving back to our cash flow statement now, we're going to record the net income that we just earned. We just earned $800 in net profit from our operations. We subtracted depreciation before, but depreciation isn't an actual cash item. So what we do? We add it back in our cash flow from operations. So we're going to add back our depreciation. And again, we didn't pay any taxes, so we'll put 0 right here. By summing these three functions, these three items, we get 820 right here. We're going to sum everything going down. Hence, you see your CFO plus your CFI plus your CFF, which is 820 minus 100 plus 100 gives you back your 820 in cash. So this is the amount of cash that we have at the end of this operation. Our auditor would sign it off and say, cool. This reflects a fair representation of the company's functions. So we signed off on our cash flow, we signed off on our income statement, and now we need to do our balance sheet. And you can know your balance sheet is correct because your assets must equal your liabilities and equity, because at the end of the day, you acquire your assets by either raising debt or raising equity. So let's go. We established that we have cash of 820 at the end of our year. So we have 820 plus 100 plus 80, which is our fixed income assets. So we add these two together. We then get 900. So what did we raise in equity from Raman? What did I ask Raman for? I asked Raman for $100. Cool. So my capital stock is 100. How much money did I make in net income? I made $800. Boom. That means I have 900 right here. And I have 900 right here because I have no debt in my business. These two things are balanced. Hence, we would have reflected a total operation of our companies. And again, these numbers are chosen randomly, and it will always work as long as you know how to manipulate or to utilize the information. And what this shows to you is that anything that happens on one has to affect the other. And this is how you go about knowing if a company has what you call an unqualified opinion. An auditor would have an unqualified opinion versus a qualified opinion. Unqualified means that is good, qualified means that is bad. Kind of counterintuitive, but that is how it works. So we're going to step back now to our presentation. So that particular session we went through on M2 and version on class 2. Because that's not the focus of this class, I wouldn't want to take questions on that particular section. When the video comes out, persons would be free to ask questions after that point in time, because really and truly that would have been done in the second session where the persons who were present would have been able to ask the questions. Due to time, we don't want to spend too much time on the past. We want to actually go into our next lesson, which is what this session is really for. So I'll take questions pertaining to this session. Cool? All right. So what did we just cover? We went through where to find our data, which is JAM-StockX. We know what data we're going to look for, our income statement, our balance sheet, our cash flow statement. I will read the notes. Now, I say we're going to get into the fun aspect of research. This is the actual fun part. This week, in this class, we'll be going through actual valuation. How do you actually value a company? How do you know a company is worth $30 versus another worth $60 versus another worth $100 versus one worth cents? How do you actually do the valuation? This part of the actual research and analysis is what some people categorize as 70% art, 30% science. Reason is that every analyst will be different. They will look at things differently. There's never any right or wrong, just appropriate or inappropriate. So you'll need to know which one is most appropriate for a company versus which one is inappropriate for a company. So we'll be going through first understanding the fair value of a particular investment opportunity. We will then go through understanding the purpose of a valuation. We'll then go into exploring the steps in the valuation process. And then finally, we'll do some valuation approaches. So again, this to me is the most fun part about doing an analyst. This is where you actually make your name in the industry by being able to do valuation. So let's start by first acknowledging what is the fair value. Now, a fair value has multiple definitions, right? The first one being, the fair value represents an asset sale price agreed between a willing buyer and a seller, assuming both parties are fully aware of what's happening. Meaning that you can't want to come trick me and hide my information and then it ask me to buy it. No. I need to be able to understand what it is you're selling. I need to understand what it is I am buying. Whatever price we both mutually agree on, that would be the fair value of that particular security that we are investing in. Cool? Fair value is an estimate of a security's worth on the open market. So if you have a house and you decide that house worth $10 million, cool. But on the open market, the market decided that house is only worth $4 million. You can't fight the market. The market decides that it's only going to be worth $4 million. That is the fair market value of that asset, right? Thirdly, the fair market is also the price at which a hypothetical willing, informed, and able seller would trade an asset at a willing, informed, and able buyer. By this definition, effectively, whatever price is recognized for that asset will represent what is its fair value. So when you talk about trading on a day-to-day basis, if I am willing to sell this stock at $30 and somebody is willing to trade and buy this stock at $30, that essentially would represent the fair value for that particular stock, because at that point in time is when a transaction will occur. And then each person, both buyers and sellers in the market of about 1,000 buyers and 1,000 sellers, each person will have their different fair value. Hence why you have a queue. When you look at the stock market, you'll have a long list of bidders and a long list of persons who are asking for prices. Only when those persons are in mutual agreement will the actual asset trade on the stock market. At that point in time, it will reflect the fair value for that stock. So the question of what the security is really worth is one that based on subjects of investing. By calculating the fair value, investors are able to answer these questions in some form, although it may not be precise, because again, this is 70% art, 30% science. When we go into the definition of value, value actually has two separate meanings. First meaning is investment value. Investment value is the value of an asset to a particular buyer. Investment value may depend on a buyer's specific situation, as well as perceived synergies with existing buyer's assets. So it's taken into consideration where we have an actual plot of land, and I have 10 properties on that land. And for me to own the land outright, I need to purchase 2 additional properties to make it that I own the entire land. At that point in time, the investment value of those additional properties, I would take it into consideration when I combine it with all the other assets. Essentially, that would represent the investment value of the company, of the 2 lots. I would then determine, say, okay, it is worth spending X to acquire these 2 additional lots, because it will then allow me to then combine it with all the other assets I have, which essentially will make the investment value. But when you speak about intrinsic value now, intrinsic value refers to an investor's perception of the inherent value of an asset, such as a company, stock, option, or real estate. So going back to that analogy of the 2 additional lots that I need to acquire, I acknowledge that, yes, there's an investment value to acquire this asset, but what price am I willing to actually pay to get that asset? Now, that would be the intrinsic value that I would have put onto those additional assets. Now, nobody can tie me up and say, all right, cool, if you want this, you're going to pay me X. If I'm not willing to pay X, then I will not do the transaction at that price, because I believe that the intrinsic value is actually lower than X. So these are the 2 different definitions of value. You have investment value and intrinsic value. Yes, it will add value to my business by acquiring this asset, but I may not necessarily be willing to pay that price, which is the intrinsic value. So these are 2 definitions we need to be mindful of whenever we're thinking about investments. Now, the reason why we do valuations is we have at least, call it roughly 7, not an exhaustive list, but roughly about 7 reasons to why we do valuations. First is stock selection. The purpose of stock valuation is to find the value of a common share, which is justified by the company's earnings, growth potential, identifying undervalued or overvalued stocks. You can overweight or underweight it from a portfolio perspective, and to generate alpha, which means excess returns. So you look at a particular stock, if you believe that this stock has future potential to be derived from it, you're only going to know that by doing a valuation. And again, how do we derive that valuation? We go back to finding our source, which is JamStockX. We'll find the required data, which is our financial statements, and then we would do valuation techniques to it to then derive a value for that stock to know if there is any future potential, should we overweight or underweight it from a portfolio perspective. Then you can utilize it to read the market. So when you speak about, especially from the perspective of market multiples, our market multiples about 5 years ago was as high as about 10 times or 12 times market. Prior to COVID, our market multiples were about 22 times, 25 times. Now, what does that mean? The earnings or the value that we have placed on our local stock market has increased by at least, my math is not that good, but you say it moved up to 25x. So you're moving from a stock market that was worth 10 to 12x to now worth 25 to almost 30x. What does that mean? We're reading the market. This market is now valued way more than what it worth, way more now than what it was worth then. And you can even understand that by looking at the fact that we would have been recognized as the best performing stock market in 2015 and recognized again in 2018 as the best performing stock market in the entire world. Now you get that recognition when you can see the value in that particular stock market. So this is where how you read the market essentially. Next, you're talking about projecting the value of a corporate action. Take into consideration the acquisition that would have been done by NCB acquiring Guardian. What does that mean for NCB? How does that benefit them? How do you utilize that information? That is where valuation comes into place. What kind of revenue and what kind of earnings was Guardian making before NCB acquired them? How does that going to affect NCB's earnings going forward? That is the point of valuation. You need to know what those certain corporate actions affect companies. And recently GK acquired Key Insurance, and everybody sees how Key Insurance price went up. Why is that? Because people believe that there's a value to be added to Key Insurance now from GK, which is a large conglomerate who has shown historical growth in revenue and earnings, to add value to Key Insurance. The persons would have felt more confident in about Key Insurance, and essentially how does that affect Key now having that kind of management in their company overseeing their operations. So valuation allows us to then project the value of corporate actions. Also, fairness of opinions. Now, a lot of things go into an initial public offering that most persons aren't aware of. Before a company even decides to list, they will go to different brokerage houses. They will also go to different firms such as PwC. Companies come to Barita. Companies may go to other brokerage houses and decide that, what do you think my company is worth? That's the very common question a lot of companies ask us. What do we think our company is worth? What could we sell it at? They're essentially asking us about fairness of opinions. At that point in time, an analyst uses equity valuation to support professional opinions about a company to derive the fairness of its price. You don't want to sell your stock for cheaper than it really is worth, and you don't want to oversell, because if you do oversell, people may not necessarily buy that stock. So when you see an IPO come out, at that point in time, you get an idea to see the different brokerage houses have different fair value prices. Because at that point in time, everybody would have their different, in quotation, fairness opinions about that particular company. That essentially gives you an idea of what it is done. For the Jamaica IPO, I'll use that specifically because we would have seen where PwC was the main company that brought them to market, essentially by finding the brokerage house, by doing valuation to determine the price. They would have essentially given NROC and the government of Jamaica their fairness opinion about the particular company. So that is again how valuation becomes important. Planning and consulting. If a company decides to do an acquisition, they want to ensure they're buying value, meaning that you'll have a lot of potential properties that you can acquire. Which one brings the most value to the company? So what does that mean? You want to make sure that you're buying assets that are actually going to generate potential revenue to your already established business. You don't want to just buy every and anything. So you need to do valuation to pick the best assets that are going to add value to your portfolio of companies, as well as provide adequate returns for your shareholders. Then lastly, communication with analysts and investors. You do a valuation and you present your valuation report to your shareholders, to other analysts, to your clients, so that they can understand this is what the company is worth. How did we derive this? We did this valuation. We took these items into consideration. All of these items will go together to then create a hypothesis about what a fair value is for a particular company, and you will do that strictly through valuation. Two additional ones is valuation of private businesses, which is essentially the same of a fairness of opinions. Before most companies go public, they would have been private first. And essentially at that point in time, you'd have been providing that client with their fairness of opinion or your idea based on valuation. What is your private business worth? You may not necessarily want to be going public, but you may be considering a private merger. Now you want to ensure that you're getting value for money. So take into consideration the transaction between SSLVC and Blue Dot. Now, Blue Dot is a private company, and they would have been acquiring shares, or they would have sold their shares to SSLVC for a particular price. SSLVC would have done their private valuation on this private business and determined a value for those shares. For that 50% stake in Blue Dot, they'd have done their valuation to determine what is the 50% stake worth. And again, when Blue Dot bought back their shares, they would have had brokerage houses that would have aided them in determining what is the value of my stock, of those 50% stake now. That shows you how you can do valuation for private businesses, and this happens quite more often than most people actually know. A lot of transactions happen in the private sector space that are not released on the JamStockX, because again, JamStock is for public companies that are listed. These are private companies. And lastly, is for portfolio management purposes. Now, you will have a large pool of securities you can buy, whether it being equities, being stocks, equities or fixed income, whether it be in real estate, whether it be in another company, but you have limited capital. You can't buy it all. That's the reality. You cannot buy it all. Hence, you need to buy the best. And you only know what is the best by doing valuation. You need to ensure that you pick the best asset to be a part of your portfolio. So you do equity valuation, can be considered a standalone function in which the value of a single equity position is estimated. It can be more valuable when you're using a portfolio perspective to determine the value and the risk of a portfolio of investments. Now, again, when you're doing valuation, you don't do valuation in isolation. You take a lot of things into consideration. Valuation has multiple purposes and depends on the purpose to why you do a valuation. A valuation for mergers and acquisition is different from a valuation for portfolio picking. So you need to understand what exactly are you doing the valuation for, which is why the purpose of a valuation is very, very important. Now we're going to go into what are the actual steps in doing the valuation. What is the actual steps required to do a valuation, right? There's no one way to calculate the fair value of a stock, but calculation typically follow these 7 steps that we have currently on the board. So what is the first step? Determining the purpose of the valuation. Went through a list of about 7 a while ago. Those would help determine what is the purpose of the valuation. And again, buying a stock for your portfolio versus buying a company to be a part of your group of companies requires 2 different types of valuations. So it's important from the onset to determine what is the purpose of the valuation. Then you need to understand the business. This is where the financial statements come into place. What are you buying? Are you buying a financial company? Are you buying a conglomerate? Are you buying a manufacturer? Are you buying a retailer? Are you buying a distribution? You have to get intimate with the company that you're actually buying shares in, or you're considering doing any form of research in. We made that emphasis again in the second class of this series, because you need to understand wholeheartedly at the back of your hand what is the company doing. You need to know what the company is doing. There's no excuse to say, I didn't expect this, there's a surprise to this. No, you need to know what it is the business is doing. And that includes the management team, that includes the geography in which they operate, that includes the segments in which they operate in, that includes the competition that they have, that includes the global outlook for that industry as well as the local outlook for that industry. Doing this form of research is very, very, very time consuming, but it's very, very necessary, because you need to be able to make a very strong objective and informed opinion about any form of research that you're going to be doing. Then we're going to gathering historical information. This is where we spoke about actually going to our source, which is jamstockx.com, to get which is our source of our information, and then we know what we're going to look for, which is the financial statements, which includes the income statement, balance sheet, cash flow statement, as well as the notes for those statements. And we also go to look at things like corporate actions. Was there any change in management? Do they pay consistent dividends? Those are important information you'd want to gather on a particular company when you go on JamStockX. Additionally, you want to be able to create forecasts for those companies. No, you can't make forecasts out of thin air. You can't just say, yeah, man, the company can grow by 5%. You have no idea why, but you just say it can grow by 5%. This is why understanding the business, the second point, is very important. You have to understand what is the industry outlook. Is the industry going to grow by 5%? No, then the company can't grow by 5%. Is the economy going to grow by 5%? No. And how is this company going to grow by 5%? These are some of the things that we take into consideration when you're creating your forecast. Does the management look competent in allocating resources appropriately? Meaning that if they raise equity of X, are they going to spend X paying out dividends, putting money in the pocket of shareholders, or are they going to use that money raised and actually acquire additional assets to complement what they already have on their books, to grow the business essentially? So when you have a company that is, you see, focusing between or deciding between paying dividends or not paying dividends, the reason that they make that decision is because they're trying to ensure that they have enough cash on their books to actually grow the business still. Everybody wants to continue growing the business. You don't necessarily want to buy a company that is just, they've reached the max. For example, Carreras. Everybody can say Carreras just pay dividends. No problem, Carrera paying dividends, because in Carrera's case, they're a very mature company. There's not much more for them to do. At this point in time, they're just paying out dividends, paying out dividends, paying out dividends. Versus a newer company that is just listed, they would not be looking to pay dividends because what they're trying to grow the business. They're trying to grow the business, so the retention ratio will be much higher. You then want to select the appropriate valuation model. Now, this is where I state that there's no right or wrong way to do a valuation, only appropriate and inappropriate. The reason why this is important is because you want to ensure that if you're valuing a company, you want to make sure that you're not valuing a financial company the same way you're valuing a manufacturing company. You want to ensure that you're using the right valuation approach to those different companies. Then you convert your forecast into a valuation. So once you already determined that the management team is competent, you determine that the growth projections look reasonable and sound, the industry looks good, everything about the company looks good. At that point in time, you combine the forecast with your valuation methods to then create a full valuation for that particular company. You would say that this company is worth X, this company is worth Y. Each company will be different based on your forecast and your valuation methodology. Then finally, you apply the valuation conclusions, meaning that at that point in time when you create a valuation, you're going to say, all right, I'm willing to spend X or I'm willing to spend Y, depending on if I want a discount or a premium for that particular asset. If I think the asset is really, really good and I think it's undervalued, I'm going to pay that premium. I want to get it before anybody else realizes what this company is actually worth. But if a company is not worth so much, I'm going to say, hey, right now, I'm not going to pay the current price. I'm going to pay probably less than it because based on my forecast, based on my valuation, I do not think this company is worth that amount. So again, these are the 7 steps. Again, essentially that it's not an exhausted list. There are more intricate steps that we could go into, but we want to focus on these 7 steps because this practically guides how do you create your valuation for a company. So when we're talking about valuation techniques, there are predominantly 3 approaches that you can use to value a company. And again, it's really based on appropriateness. Once you create your forecast for a company, you need to apply the correct and appropriate valuation technique to that company. Now, valuation approaches are broken into 3 main steps, which is cost approach, also known as asset approach. Essentially saying, what are your assets worth? You have assets on your book, what are they worth? As simply that. I don't care about future earnings, I don't care about anything like that. At this point in time, this is what your asset is worth, also called the cost approach. You will look at the market approach, also called a relative approach. Most persons will be familiar with this one. This is where I talk about PE, PB, other companies are worth this, so my company is worth that. So, sorry about that. So at that point in time, that is what your market approach or your relative valuation is speaking about. Then you're talking about cash flow, discounted cash flow, or your income approach, you're looking at what kind of cash does this company generate. Are they actually generating cash, or are they bleeding cash? You need to know what kind of cash flows are you getting from this investment. Because really and truly, when you make an investment, the idea is that you're eventually going to get back your money plus some at the end of your investment horizon. That is the whole point of why you're doing any form of investment. So again, these are your three main categories. Each of them will have different subsections under it. Each will have different subsections under it, but again, these are the overarching methodology that they utilize for valuation. So we're going to go into the first one, which is cost approach or asset approach. So the asset approach is saying that asset-based valuation is a form of valuation in businesses that focus on the value of a company's assets or the fair market value of its total assets after deducting liabilities. Assets are evaluated at the fair market value. After the fair market value is obtained. The asset-based value is useful for private companies in certain type of analysis as added due diligence is done. Furthermore, the asset-based valuation can also be important consideration when a company is planning for sale or liquidation. So what does this mean? If you're a company that is looking to be acquired or looking to be sold, what are you acquiring exactly? I'll use NTB for example. When NTB acquired Guardian and Claren, you would have recognized they had something called negative goodwill. What does negative goodwill mean? Negative goodwill actually represents the difference between the assets and the liabilities, which is your equity value, some will classify it as, or your net assets, and then the price that you actually pay for those assets. The difference will be your goodwill, whether it be in positive or negative. We'll get into that at different masterclass sessions, but essentially, what are you paying for the assets of these companies? Are you paying more, or are you paying less than what they're actually worth? So that is the asset-based approach. An example of what asset-based approach looks like is this company. You have a company that has total assets of 756 million. Has liabilities of 168 million. When you subtract the difference between the two, you have 588 million as your net assets, also referred to as your equity. When you divide that equity by the outstanding shares, you then develop a fair value price of $5.22. Now, you may not necessarily pay $5.22, you could pay $6, or you could pay $4. If you pay 6 or 4, you develop a goodwill, whether it be negative or whether it be in positive goodwill. So this is just showing you what is the value of the company just by simply subtracting its assets, subtracting its liabilities from its assets. You have an adjusted asset-based valuation when you take into consideration of things like depreciation and intangible assets, inventories, receivables. But again, the method is the same. You add up all your assets, you subtract all your liabilities, and you get a net asset value. You divide that net asset value by the number of shares and develop your fair value. This essentially is the asset-based approach, and is utilized most appropriately for companies that are considered to be conglomerates or manufacturing companies. This would be one of the most appropriate for those type of companies. When you talk about income approach now, income approach, there are two main approaches when valuing a business, either through the capitalization of cash flow method and the discounted cash flow method. These methods are used to value a company based on the amount of income the company is expected to generate in the future. The income approach is typically used for income producing properties and is one of the three popular approaches in appraising real estate. So if you actually are going to look to buy a development or buy into a real estate development, you'd want to know what kind of income are you going to generate, whether it be in rental income or is it going to be the sale of the property after it develop. You'd pay 10 million to actually acquire the asset. You can then sell it for 15 million. You'd have earned 5 million. Or you can acquire the asset for 10 million, pay a mortgage of 100,000, but actually charge rent of 200,000. That 100,000 difference is your income you're earning from this real estate transaction. And eventually, after you pay off the life of that mortgage, you'd have then recouped your investment plus earning interest essentially on that property. To showcase the income approach, the common income approach utilized in research for most companies, the dividend discount model or the Gordon growth model. Again, what we look at is what are the dividends paid off for our company. We apply these formulas. We won't go into detail about the formulas. A lot of academics in the past sat down for long nights and early mornings and developed these methodologies. And this is what came out. We apply the information required, which is the dividend received, the rate of return expected, the long-term growth rate, and the short-term growth rate of a company. And we would then develop these values or fair values. And again, all you're essentially doing is dividing the number of shares outstanding by the equity value to then create your fair value for the particular company. So under the H model, you'd have a fair value of 316. Under the Gordon growth model, you'd have a value of 221. This is essentially just breaking down, utilizing the formulas, how much is the company worth based on the amount of dividends that they pay. This is just an income approach, and you have many different ones, but for this purpose of this class, this is what we'll be focusing on. And lastly, which is what everybody is most commonly used to, is a market approach. Market approach to a business valuation involves attributing value to a business based on the value assigned by market forces in comparable situations. So for example, NTB, JMMB, Sagicor, those are all financial conglomerates, and they're all operating in the same space to some degree. Each have an insurance arm, each have a financial arm, each have an investment arm. So essentially what I'm saying to you is that I do not expect NTB to be that much different or operating that much differently from a Sagicor, which is then operating that much differently from JMMB. Now, they will act unique in their own right because, for example, JMMB operates in Dominican Republic and Trinidad, which Sagicor is not. But then Sagicor is a part of a financial group that operates in the United States. And then NTB, they focus on they're in Guardian and Clarion, which is a regional conglomerate. So each company still has their different unique attributes. By the end of the day, they're all operating in similar fashion. Hence, they are considered to be a fair comparable to utilize when valuing a company. And you can also utilize that when you're talking about private companies. So when you see an IPO coming out, for example, not Jamaica, you're talking about First Rock. First Rock would have been considered to be a real estate type of company. So you look at all the real estate companies that are currently listed. What does the market value those companies at? Hence, this is what First Rock should be valued at. That is how you kind of look at First Rock. Again, but First Rock is a real estate company, so you'd actually prefer to use the income approach. But it gives you an idea of how you can look at companies that are private, looking to come public, how you can use a comparable or a market approach to determine the value for that particular company. And just for example, you have different companies, which are your peers. They have their individual PBs, individual PE. You can take an average. You then apply those averages to your own individual book value per shares, which is essentially your net asset value, or you can apply it to your earnings per share, which is the net income divided by number of shares outstanding, and you develop your fair value. This is the most common approach people are familiar with. But internationally, there are multiple more approaches. You could talk about enterprise value to sales. You can talk about sales to goods manufactured value. There's so much more. But due to our local market, these are the most common approaches people tend to utilize. So at this point in time, I'm going to stop to ask if there are any questions anybody would like to ask about any of these valuation methodologies, or is there anything you'd like me to go over? Because after this, we're going to actually go into doing a valuation. Sean just asked a question a while ago. Based on our local market, what method, how do we, or what industries do we believe is more appropriate for the different valuation approaches? So for example, our financial sector, we prefer to use justified PB or PE. Again, they all operate within the same idiosyncratic factors, meaning that they operate in the same environment. So what affects one will affect the other. So we'd use a PE, PB. It is most appropriate for those companies generally. Again, we're talking about looking at companies like real estate companies. So you're talking about your K-Preet, you're talking about your SML, you're talking about First Rock that just listed. You don't want to use your income valuation to get a valuation for those companies, essentially. And then when you're talking about the asset base, you're looking at your conglomerates or your manufacturers. You're talking about Wisynco, you're talking about GK. You don't want to use your asset-based approach for those companies. Now, a fault of our local market that people just tend to utilize PE and PB outright. Oh, PB this, PE that. Remember when Jamaica came on, everybody was like, oh, the PE is this so high. But PE, PB was not appropriate for a company like Jamaica, which is a cash-based company. Hence, income approach would have been the most appropriate methodology. So as you become a better analyst, you can't just follow what everybody else is doing, which means that because the local market tends to use PE, PB, we're going to use PE, PB. That is wrong, and that is not how you become a better analyst. You have to ensure to use the appropriate methodology that best fits that company. So thank you, Sean, for that question. Does anybody online have any questions? Is everybody clear with what has happened so far? Nothing for me to go over? I'm taking questions. Kerry, anybody? Nobody has any questions? So everybody is a top-notch analyst at this point in time and know what to do, I'm assuming. All right, then. So if I ask any question, everybody should be able to answer. The 3 valuation methods. Okay, so I'll actually just briefly go over the 3 valuation methods. So the 3 valuation methods we tend to utilize are categorized broadly as the cost approach or the asset-based approach, the market approach or the relative value approach, or the discounted cash flow or income approach, intrinsic value approach. Again, the cost approach or the asset-based approach is essentially saying to you, when you take that asset, the fair market value of those assets, you then subtract it from its liabilities, you then get the actual value of the company, you divide it by the shares, hence you develop what is the fair value for those shares. For the market approach or the relative value approach, you then look at the company, look at its shares and say, its comparable peers tend to trade at this PE or they tend to trade at this PB. Hence, this company should be trading at this PE, should be trading at that PB. You would then multiply that PE or PB by your earnings per share or your book value per share, and then that would be your fair value price for that company. That is from a comparable perspective or a market approach. You discount the cash flow or the income approach, you're essentially looking at what kind of cash flow is this company generating. At that point in time, you say, if the company is generating this kind of cash flow, based on the formula that have been studied and created by people long time ago, when you utilize those formulas and utilize the information that would be required to input for those formulas, you'd have developed a fair value for that company through its cash flows. Is that clear? So that's a good question. So the question was asked, if a company like Transjam, where there's no company like Transjam, how would you have done that valuation? Now, Jamaica, again, would have been the first of its kind. It would be considered to be an infrastructure investment. Now, it is not the first infrastructure investment globally. It is not. But for our local market, it would have been unique. So what did we do? We chose the income approach because that is the most appropriate methodology to apply for companies like this. Because at the end of the day, Jamaica, they literally earn pure cash. You just cash at the toll booth. You can't take credit card and use it at the toll booth. There's no receivables. It's strictly cash. So what does that mean? It is best to utilize the income approach when you're talking about a company like Jamaica, because they would be able to pay out dividends because they have a pure cash flow based methodology. So a company like Jamaica, you'd want to use the income approach because again, it's a purely cash company. It has no ready available peers, hence the market approach wouldn't be advisable. And you can't want to buy the people them highway, so you're not going to want to use the asset approach. You could use it, but it's not the best approach to use. Income approach would be a better reflection of that company operation to get a value for that company shares. Does that help? No, so these are, so what I've listed to you, let me go back to that slide. What you would find, or if you guys are in class, what you would find is that you have a bunch of different valuation techniques under each of these. So these are just the broad categories. So you're either doing an asset-based approach, you're either doing a market-based approach, or you're either doing an income-based approach. So those are the 3 main types. But then you have a bunch of them under them. So that you're talking about free cash flow to equity, free cash flow to firm under income approach. You're talking about PE, PB for market approach, including enterprise value to sales, enterprise value to GMV. Those are all under market approach. Your asset-based approach is the simple of all of them. Essentially, just asset, again, you're saying you're just subtracting your assets from your liabilities to derive your fair value. So these are your 3 main overarching approaches. But under each of them, you have a whole bunch of different methods you could use. Does that help? All right, cool. So are there any more questions? This is the best time to be asking your question, guys, because this is really for your purpose. Because remember, the whole point of the masterclass is that you're going to be confident. If somebody asks you, why did Barita choose to use the income approach for Trans Jamaica while IC Insider decided to use PE? You need to be able to explain to your client why was that inappropriate, why was our methodology appropriate, and that is a very important concept. From you wearing the Barita shirt, nobody's not going to know you're in research or you're not in research. They're going to ask you that question. You should be able to answer that question. So I'm imploring you guys, this is the opportunity to ask a question. There's no dumb question in my mind. Everybody is trying to learn, and I believe that you learn by asking questions. So I open the floor again. Are there any other questions that anybody would need to ask? If you're unsure, if it's even the smallest thing, I will go over it. It doesn't make sense. We end this session and you're still unclear. So is there any other question anybody would like to ask about anything that we have gone over so far? Okay, so what Sean has asked a while ago is then people will make reference to companies being dividend stocks. And by dividend stock, they mean that those companies tend to pay a very, very high dividend, having a very high dividend yield. So in truth, companies actually, what you don't have to use this company the valuation methodology in isolation, meaning that if you use one, you can't use the other. So I'll use Careers for example, and I'll also use NCB and Sagicor for example. So NCB and Sagicor, they pay dividends. People don't call them dividend stocks, but they pay very good dividends in truth. So what you'll find is that on top of your PE and PB approach for Sagicor, you'll also look into using the income approach to get an idea of what would be the company's worth if you consider their dividends. Same thing for Sagicor. Scotia is a company that persons tend to call dividend stocks as well because they tend to pay a very, very high dividends. Now the reason why PE and PB is not appropriate for Scotia, or not is not appropriate, is not ideally used because Scotia is a company, they don't have that much growth prospects. We see where they're cutting back. They're looking to consolidate, It's actually a rumor that, they're actually setting up themselves to be sold because that's what a company does at this point in time. You want to make sure you're cutting your trimmings around and making sure it looks proper so that it can be sold to whatever inspiring acquirer. We see a lot of Canadian companies are selling out most of their regional banks, where recently I think First Caribbean was actually sold to a Colombian company recently, and we already saw where Scotia pulled back from all the other regional stakes. So at that point in time, you can get the idea that the growth in Scotia is not really there, but they pay very good dividends. So income approach would be most appropriate for a company like Scotia. So you can utilize more than one valuation on a particular company, especially conglomerates that actually are in a lot of different areas. So actually the company that we're going to be doing our valuation on is going to be a conglomerate company. At that point in time, we'll be able to utilize all three methodologies on that company. So one last roll call for questions. Any other questions from anybody? You can use all three. So for example, you have a conglomerate that is bleeding cash, meaning that they're not generating a lot of cash. You may not necessarily use the income approach for that conglomerate. So I'm glad you asked that question because I believe that there's a misinterpretation going on. There's no hard and fast to which one you can use. Again, there's no right or wrong. It's just about appropriateness. And again, I utilize Sagicor and I utilize Scotia. You could use Scotia because they're still a group. You could use PEPB to value Scotia. You wouldn't be wrong. But is it really appropriate, given that Scotia is not looking to grow as fast as their actual peers? Hence, no, but they pay good dividends. So you use the income approach. Same can be said for Sagicor and NCB. They are looking to grow as well as they pay dividends. So you can actually utilize both PE, PB, and dividend discount model. You have some companies that you only want to apply income approach, or some companies you only want to apply the market approach because they're not necessarily paying dividends. So a company that doesn't pay dividends consistently or pay dividends at all, you would look to use the income approach even if they are a real estate type of asset. If they're not paying dividends, then you wouldn't use the income approach, but you'd use other approaches instead. So there's no hard and fast about if you use one, you can't use the other. No, it's just about appropriateness, and the appropriateness based on experience and based on the actual understanding of what the company is choosing to do. So for example, take Panjam under consideration. Panjam is really a real estate based company that also has an equity portfolio. Right. So again, so there's no hard and fast methodology that you can utilize. It's really based on your appropriateness. So you'd have to be familiar with the company's operations to actually determine which approach would be best suited for that company. And as utilizing Panjam as my example, Panjam at the core is really a real estate based company that also has an equity portfolio. But that is how their revenue is generated. But if you actually look at the bottom line, which is the net profit, you realize that their net profit is actually about, if I did the math correctly recently, it's about 90% in Sagicor, meaning that if Sagicor makes profit, Panjam makes profit. How do you value a company like that? No, they're a conglomerate essentially because they have operations in a multiple different portfolio of companies. Choka, they also have shares in we call it their Finance Term Limited, Regos. They have a bunch of different positions in those companies, but they also have a real estate book or portfolio. Now, a company like that, you can have different methodologies that you use. So again, this just kind of gives you an example to show you that you don't have to use only one. You just utilize the ones that are best appropriate for a company like that, essentially. So it's not hard and fast which one you use. You just ensure that any one that you use is most appropriate. And you can determine if it's appropriate really by, what I tend to say that if somebody was to look at my research report and ask me, why did I do what I do? If I cannot explain it, clearly I did the wrong thing. If I'm not able to justify why I utilize this approach, then clearly I'm utilizing an inappropriate method. And there's nothing wrong with being wrong. And I'll emphasize that again to everybody. No research analyst in this industry will honestly know it all. Persons with more practice and experience will get more things right. But the objective of being a researcher is to get it wrong the least. That is just the truth. Anybody will tell you, try to get it wrong the least. If you know it all, you will not be doing research for anybody. You'll be doing your own research and making a bag of money. So the idea is that you try to be wrong the least. And that is the main objective when you're doing research. So at the end of the day, everybody will just instantly know, for people who are more experienced, will just know off the bat what approach to use for a company. They'll just know instantly. Some person will have to do some research behind it and then determine, but there's no hard and fast to which approach you can use. And that is the, essential what I want to bring across to everybody. There's, you can utilize all of them. You can utilize one of them. You can utilize two of them, or a company could just be bad all around. They don't utilize any of them. You just don't bother. That's not true, but you get what I'm saying. It's really just trying to determine which one is most appropriate for that particular company. So with that question, I'm going to actually go into doing a valuation now. Right. So I'm going to actually do a valuation now for a company. Now, I'm not going to do a listed company because nobody asked me what I think the company worth. So, what I'm going to do is I actually utilize a conglomerate-based type structure, which allows me to then utilize all the different methodologies at our disposal. So here we have this conglomerate. I'm going to call it Company X for the sake of this purpose. This company is a conglomerate because you see that we have finance income, which could be from their financial arm. They also generate revenue and cost of sales, which is predominantly a function of manufacturing companies. So what we're looking at right now is a conglomerate-based company, and I was just trying to show you why it's a conglomerate-based. Historically, we're looking at have our finance income right here. We also have cost of sales and revenue, which essentially is a feature of a manufacturing-based company. So this allows us to do is utilize a multiple, all three of our valuation methodologies. And this is important because I want to show you how all three of them are done. Now, one of the very first steps in doing a valuation, again, is to understand the business. Now, for the purpose of this, I've already done the understanding for you guys, so you don't have to worry about understanding the business. But we wanted to gather historical data. So these two columns right here are historical data. This is 2018, 2019 already gone. And again, these forecasts are our pre-COVID forecasts. So this is how the company performed historically, these two columns. So in short, what we would have done is gone to JamStockX, got our data, typed it up essentially, and would have decided that, okay, cool, this is how the company performed historically. Then, based on its performance, we can see the CAGR was about 6.1. So your revenue was growing about 6.1. How do we think it should grow in the future? Below here, we have different growth projections for each company. So I believe in 2018, in 2020, I believe that revenue is going to grow by 5%. I think cost of sales is going to be about 47.6%. You can be personal expenses about 21.5. It kind of get a gist of what these ratios represent. What the model allows you to do is that you can change these variables that would eventually change everything else. Everything changes once you change any of these variables. So once it changes to like 50, you see your cost changes. You see these earnings per share. Your ratios are changing. And that's essentially how you do a valuation. You'll be playing around with these numbers to get a better reflection of what you believe is an appropriate methodology, appropriate forecast for that particular company. So not to get into the nitty and gritty of the details, this is our financial model essentially. And at the end of it, we have our earnings per shares for this company. These are earnings per share for 2020, 2021, 2022. This is what we expect the companies are going to make in terms of net profit over this 3-year span. We then go across to look at the balance sheet, because the reason why the balance sheet is important is because we need to be able to see how exactly does our equity base grow, because that is where we're going to determine our book value per share. So once all the assets are taken into consideration, and again, I would have already done all the assessment for you guys in terms of determining what a company value is, in terms of the assets, etc. Our retained earnings, just like the example I did earlier in the class, is really a function of the revenues or the profit earned by the company. So these are our net profits. These are our retained earnings for the company, hence our equity base is growing. And then when you divide that by the number of shares outstanding, you get a book value per share. So again, don't get hung up on what is happening on the balance sheet, but what you want to focus on is these line items. When you go through the second class on the video, you'll be able to see how are these balance sheets created, whether it's liquidity approach or categorization approach. Essentially, what we're doing right now is just simply determining the important elements, which is earnings per share and their book value per share. Then from our cash flow, what we want to see from our cash flow is essentially what kind of dividend is this company paying? Have they been paying dividends? Yes, they've been paying dividends. We're projecting that based on their historical payout ratio, they will be paying dividends out to their shareholders. Now that's a good thing for persons who are looking for dividends for a particular company. And we can see the dividends payout ratio is an average about 50%. That's kind of dividend ratio that they plan to pay out to their shareholders. So now that we kind of get the idea of what the earnings per share is, the book value per share is, and what kind of dividend payout ratio they have, we then go into our actual valuations. So from a market approach, it's similar to what you saw before, where you have your different companies. You have an average of these companies because these would be your direct peers. As you can see, you have some larger PEs or PBs, and then you also have some smaller ones. Again, the larger PEs could be representative of a higher growth rate for those companies. So this could be your NTB or your Sagicor versus a small company like a VMIL would have a lower PE. That just market expectation of what the company is worth. So once you average these now, you then apply them to your actual earnings per share that you would have had. You see 0.259 right here. This is coming from, on this page, 0.2598. Just to show you guys where it's coming from. Same thing for our book value. You have 3.077. This is coming from our balance sheet of, well, if you extended this ratio, you'd have seen 3.077. So that is where these ratios are coming from. You multiply these book values and earnings per share based on your average multiples. You then derive a fair value for this company. You can then average the two methodologies and then get your average fair value for this company. Now, this is one that most people are familiar with in terms of how do you value a company. Again, all you essentially do is that you create your forecast, which is what we did. Created our forecast earnings per share. We created our forecasted book value per share. We found the average of this company's PE and PBs, applied them, and then multiplied it by our expected. And again, we do this because we believe that if they're operating in the same space as their peers, they would then be able to say it is worth this amount, and this is what the fair value output is. I will ask at this point in time, is anybody unclear on what we did to derive this fair value based on the market approach? So we're going to go on to our income approach now. So we established that the company pays out a dividend of 50% of their earnings. So what does that mean? If they're paying out 50%, if they generate, let's say for example, they generate a revenue, net profit of 100, 50% of that is going to be 50, hence the dividend is going to be 50. So in this case, we would have found 50% of all of the earnings that the company would have made over these time periods. And then we'd utilize this to then generate what we believe would be a fair value of the company. Now, these are the formulas that we did. We utilized, this is called the H model, and we have the Gordon growth model. We won't get into details of how these came about or in terms of the actual makeup of the formulas. But all we did essentially is apply these formulas where we have our long-term growth rate being 5%. We have our short-term growth rate being 35%. Our cost of equity is or the rate of return we expect from this company is about 8%, and H is just half-life, so I won't get into what half-life means. But when you utilize these variables in this model over here, you are essentially creating a fair value of $3.16. And again, this is just simply dividing the enterprise value by the actual number of shares to derive this right here. Same thing for the Gordon growth model. You utilize this formula with the same variable that you have right here, apply it, you derive your equity value, you then divide it, the equity value or enterprise value, and then you divide that by number of shares outstanding to then get what is this company shares worth. I'll ask at this stage, is anybody unclear with what we did right here? Don't get hung up on the formulas itself. These I just want to make sure you understand how do we derive these fair values. Is everybody clear at this point in time? I tell that yes. Finally, the simplest approach is just simply the asset-based approach, where you just simply, we have our assets for 2020, we know what our liabilities are going to be, we subtract the difference, which is our net assets, and then divide it by the number of shares outstanding. We would have then developed our fair value price of $5.22. And that's literally all it takes to do the asset-based valuation. There's nothing more about it, nothing more intricate. It's a very, very simple methodology to apply. And we applied it here and saw a price of $5.22. We then look at our actual model in collectively and determine under the multiple approach, which is the market-based approach, we saw $3.16, $2.16. Under our income approach, we saw $3.16, $2.21. Under our asset-based approach, we saw $5.22, $5.35. Now, why is it that three different methodologies or three different approaches give us so many different results? It's just based on how the valuation is done and which one is more appropriate. Now, if you're valuing it from an asset-based approach, this shows me that it has very strong assets on its book, right? So if you only consider the asset that this company has, that is the price that you would have to pay for it. But why would this not be appropriate sometimes? What if they only have intangible assets, meaning that the value of a billboard, a value of the road or concessionary agreement, I mean, you can't want to take the people them billboard. Hence, this may not be an appropriate methodology to utilize. I'm just giving an example of some of the shortfalls in utilizing the asset-based approach only. You have to look at what kind of assets do they actually have. Is it more tangible or intangible? Then, you're looking at the multiple approach. Multiple approach is seeing $3.16, $2.16. But what if this company isn't not really that close to its peer, meaning that they actually have an additional arm that the other companies don't have? And maybe want to give them a premium to what they actually have in terms of their peers PE or PB. Hence, these prices could go up. Or they could be smaller than the other peers, meaning that they just enter in the industry, hence they wouldn't have the same flexibility as their other peers. Maybe you give a discount to the PE. This is some of the things that have to go into doing a research. As I said, 70% of it is art, 30% is science. What we're looking at is just the science part of it, applying formulas, subtracting this, adding that. That is the easy part. Anybody who has Excel skills can do this part. The actual science, or what actually makes you a researcher, is actually applying the forecast and actually applying discount or premiums appropriate for the companies based on your outlook. So once we have derived our different fair values based on the different approaches, you can then say, all right, this is how it looks from a comparative basis, and then on average the company would have been worth $3.54. So then if you were an investment banker, you would then say to a client and say, hey, based on our valuations, we think your company is worth $3.54. Hence, we're going to write up a prospectus go to FSC, get approval, and sell your shares for $3.54. You clearly can't show them the $5.22 or the $5.35 because I'm going to say, why I don't sell my shares up there? You want to utilize the one that you believe would be a best reflection of the company shares. Hence, you may choose to do the average, because at that point in time, when you actually go to the public, you won't see any heavy criticism to say, hey, why are you selling the shares for so much? On average, this is what the shares is worth. And this is essentially what goes into actually doing valuation for a company. We would have missed out on most of the intricate part, which is actually gathering the data, typing out the financials, doing the research behind the company, meaning that who's the management, what kind of industry do they participate in, what are some of the things that affect that industry. We skipped over those parts because that is what most people consider the boring part of research for some people, because essentially that is just reading, gathering your data, and getting your opinion. So that is the 70% part that I mentioned in terms of research. How well can you actually do research? Can you find information, or can you gather insight that other person probably missed? Like, for example, when Grace Kennedy acquired Key, what does that mean? Now, our market is very slow to interpret data. So what does that mean? Essentially, GK is going to be now providing management support to Key's insurance. We saw where they changed all their management team. So what does that mean? Key can probably see better cost optimization and essentially better net profits in the future. A good researcher would have been able to interpret that and then instantly buy Key shares from it was still listed on the junior market. People wouldn't have waited till they saw the rally. Those are those people who are slow to the party, and those are people who are essentially saying chasing the stock. A real researcher would have already bought it before it even moved to the main market. Again, same thing can be said for JMB acquiring 22% stake in Sagicor. A lot of people have not taken into consideration what does that mean. They have literally not bought Sagicor Jamaica, they have bought the group, which is Sagicor Financial Corp, meaning that they're going to essentially have 22% of any net profit earned from all of the different Sagicors in all of the different regions. So that alone is going to be a big boost to JMB's bottom line. But again, the share price doesn't reflect it. What does that mean? People are not incorporating that. So a good researcher is going to be able to get those insights from general information. I promise you, if you put a newspaper in front of somebody, what one person sees is not going to be the same what another person sees. One person sees general information, another person sees opportunity. And that is where the 70% comes from. You being a good researcher depends on your ability to take information, synthesize it, and actually create from insight from it, and then apply that to your model to best reflect what you believe would be a fair value for that particular company. So that kind of summarizes what this lesson was about. At this point in time, I'll ask if there are any final questions before we wrap up the class. Okay, cool. So the question I asked a while ago was that when we look at a prospectus for a company, is there any errors in the actual information presented or calculation presented that would require you to utilize a different methodology than what was in the prospectus? No, truth is, you can look at any prospectus, they don't tell you how they value the shares. No prospectus will tell you that, and that is the truth, because they do not want you to replicate what they did. They will not tell you what methodology they use. It's really for you to then develop your methodology based on the business model. So to the extent there's calculation mistakes in a company prospectus, it will just change what kind of output you would get in terms of if they added something where it should have been subtracted, etc. like that. But you won't essentially see what valuation approach they used. You're really not sure what valuation are used for most of these IPOs, only because Jamaica was such a large one and such a public one, why they actually told you or told us as analysts what approach they use. Most companies do not tell you what approach they use, and they are in their right not to tell you what methodology they use to value a company. That answers your question? Okay, so that's a good question. So the question asked was that, is the enterprise value the same thing as the market cap? Or is it more complicated than that? So the enterprise value is a function of the market cap. For those who are listening, what the market cap essentially is that you take the number of shares outstanding of a company, and then you multiply that by the price of those shares. That gives you your market cap. So if you have 100 shares, you multiply that by 5, your market cap is going to be 500. Your enterprise value takes into consideration your market cap, your cost of your debt, as well as the cash you have on hand to get your enterprise value. So what the equity value is, or your enterprise value is that it is your market cap plus your debt that you have on your books, minus the cash, and then that is the enterprise value. And if you think about it, it's the same thing as saying it is your equity value. Because equity is the same thing as your assets, which is your market cap in quotation. Subtract your liabilities, which is your debt in quotation. And then when you subtract your cash, you get the enterprise value, which is equivalent to your equity value. So it is the enterprise value is different from your market cap. It just takes into consideration your debt as well as your cash. No problem. Any other question, guys? All right, I think no. So this brings us to the end of this week's version of the masterclass. I believe the next session we will be focusing on fixed income securities, talking about the yield, talking about what goes into credit spreads. We were speaking about fixed income securities specifically. How do we actually determine is that good credit or is it a bad credit? That is what we'll be focused on in the next session. Again, once the video is released for the two previous sessions plus this one, you'll be able to follow along and develop that knowledge that you're seeking in terms of the ultimate goal by the end of this round of masterclass is that you'll be able to create a portfolio that will have equities, alternatives, as well as fixed income, and that that portfolio would be reflective of the risk profile for that particular client. Again, at the end of the day, you want to ensure that a client that has a high risk profile, you do not give them a low risk product, and that our client that is low risk profile, you do not give them a high risk product. You want to ensure that there's a proper matching of risk profiles to risky products. So again, thank you guys for joining this class. The next class will be published by HR. And if there are any other questions you'd like to ask after this, you can reach out to me. And again, the videos will be published for you guys to review at your own time and own pace. I'd implore you guys to utilize Jamstock website. It is a very, very useful website. Again, that website has every information you would need to actually derive the information that you would put into your forecast for this model, for these different models. And again, the website is always up. It doesn't turn off when work is done. You can utilize it whenever you want. So thank you guys for joining this week's session, and I'll hear from you guys soon.